Hey everyone, and welcome to another episode of Brett's Brain. Today we're going to continue our series focused on strategies founders should be thinking about during a black swan event or an economic downturn, which is what we're in the middle of right now. In our last episode, we talked about building a financial plan and a strategy before you make any rash decisions. Today we're going to talk about fundraising. Anytime there's uncertainty in the markets, it becomes much more difficult to fundraise. That's what's going on right now. In the immediacy, those first 6 to 12 weeks after something bad happens or there's an immediate downturn, everything tightens up. Funds say things like, we're going to focus on our existing portfolio. Angels typically have lost a lot of their net worth, and so they tighten up. It becomes really hard to close a round of capital. And depending on how bad things get, it might be hard for a year or 2 years before things start to loosen up a little bit. And so what should you do as a founder? If you were in the middle of a fundraising round, you need to think about how do you close whatever capital you have committed as quickly as you possibly can. Don't wait until an entire round is committed. Or if you have people sitting on the fence, what can you do to get them from being a fence sitter to closing right away? And usually what that means is offering a little bit better valuation. Incent them a little bit more to close right away without having a whole round committed. And the investors are going to be taking a little bit more risk. They're taking future financing risk. They're taking valuation risk because they don't know what's going to be, the world's going to be. And these are just a couple of reasons they become hesitant to close on a round that they might have seemed excited about just the day before an event happened. And so in your shoes as a founder, it's your job to basically stop negotiating, to start giving a little bit more on some terms that might have been really important. But you know what? The most important thing is to make sure you have enough cash on your balance sheet to survive through this downturn so you can come out stronger on the back end. And if you're trying to build a huge company, a little bit worse valuation today might not matter. Second is if you haven't even started fundraising, it's going to be real hard to kick off a fundraising event right now for you as a founder. What I would do first and foremost is go to any existing investors or angels that you already have on your cap table, put together a really friendly round. Again, you're going to be giving up valuation in most cases here. And if you really need that cash, go out, offer something really friendly, and bring additional capital on your balance sheet today as quickly as you possibly can. And again, you have to keep in mind that in both these scenarios, giving up a little bit in valuation today might feel bad, but the reality is we don't know what the capital markets are going to do in 12 months, and valuations might still be depressed. So the valuation you get today might be level with what you're going to get 12 months or even 24 months from now, even if you make business progress. We don't know really where things are going to go, but what we do know is that you need to survive. A second idea is if you don't have existing investors or existing portfolio companies, start thinking about alternative ways to finance your company. There's a lot of different grants and government subsidies that are coming out right now, not just in the United States, but across the globe. Also think about those suppliers that you have. Can you extend your accounts payable? Can you call down accounts receivables faster? How can you get creative to put additional capital on your balance sheet immediately? If you do need to go out to people outside of your existing network, go to people that you've already talked to. Start with those people that you've already talked to first. And again, maybe open up your last round of capital, that same valuation, to entice people to take a little bit additional risk to put capital on your balance sheet today. The other thing that it might mean is that rather than raising the $1 million round that you were planning on raising, you might raise a little bit less. Raise $250,000, get a little bit lean. You're not going to make as much progress as you would have otherwise, but survive for 12 to 15 months on a little bit less capital. So you take a little less dilution today, but hopefully get to a point where it's going to be easier to fundraise again. These are all little tips and tricks, but the moral of the story is you're going to have to be willing to give a little bit today because investors are also taking more risk in their business. And keep in mind, if you're trying to build a $1 billion company, an extra % or 2% of equity that you give up today to allow you to survive isn't going to mean much to you down the line.